and they're doing no business right now. And those ships are turning around in the Pacific Ocean, but they want to negotiate and they want to have a meeting, and we'll be meeting with them at the right time. Look, they're suffering greatly. Their economy is suffering greatly because they're not doing trade with the U.S.
Just weeks after President Trump slapped Beijing with a punishing 145% tariff, China is blinking. In a stunning reversal, U.S. Treasury Secretary Scott Bessent and Trade Representative Jamieson Greer will now meet face-to-face with Chinese leadership in Switzerland, marking the first high-level talks since the tariff blitz began.
The world has been coming to the U.S., and China has been the missing piece. We have shared interest that this isn't sustainable, as I said before, especially on the Chinese side. And, 145%, 125% is the equivalent of an embargo. We don't want to decouple. What we want is fair trade.
Hello, everyone, and welcome to the Big Money Show. I'm Taylor Riggs, and joining me are my co-hosts, Dagan McDowell, Brian Brenberg, Jackie DeAngelis, and with us for the hour, Fox News contributor Jason Chaffetz. Great to have you.
Hey, thanks for having me.
Meanwhile, this is the clearest sign yet that Trump's economic pressure campaign is working. While critics called the tariffs reckless, Beijing's sudden willingness to talk says otherwise. Reports are now showing protests from furious factory workers are spreading throughout the communist country, and at least 16 million jobs could be at risk, all according to Goldman Sachs. Meanwhile, Wall Street at least starting to appreciate some of that news. The S&P 500 back firmly in the green, up 0.2%. Jason, let me come to you on this, because I think what Scott Bessent said that I really liked is, it's not really a matter of who blinks first, but again, the pressure is unsustainable, and you're starting to see that within some signs of Chinese economic data, which I know some people say, can you really trust it? Can you not? But you're starting to hear reports that indeed there was enough pressure exerted that they're willing to come to the table. Yeah,
China's position that they weren't going to come and negotiate was kind of a silly non-starter. We all knew it was going to happen. Look, this is a meeting to have a meeting about setting up the next meeting, but it's still good that they meet. And look, we'll probably have a pope before we have a China trade deal, but nevertheless, I think it's healthy. And I am so impressed with Secretary of the Treasury Bessent. He is just fabulous, and it will be a solid representative in these types of discussions. But it's a good starting point, long ways to go. Lots to work out, but things that aren't always trade, like fentanyl and other things that are also part of the deal.
I don't want to front run my Pope segment, Jackie, but you were sitting here when I was reading a statistic that said in the 18th century, it took us 3 years to find a new Pope. Let's hope it doesn't take that long to do a China trade deal, right? Hopefully maybe a couple months or so. Jackie, talking about Scott Bessent in a hearing this morning, he was pressed to give specifics on individual countries that he was in negotiations with. And he did say it's going to be detrimental to the U.S. if I start to name specifics, but confirmed that there were 18 trading partners, and we are moving forward with deliberate speed with all of them. Some of them are quite advanced, and we believe that we have agreements in principle and paper. We'll paper over them in the coming.
For companies like Nvidia and many of its large tech peers, artificial intelligence, AI, has been a huge catalyst. During the AI revolution, Amazon's own valuation increased by almost $1 trillion. Even though Nvidia currently has a larger market capitalization than Amazon, the cloud computing and e-commerce behemoth may surpass its semiconductor rival by the end of the decade. Over the past few years, artificial intelligence, AI, has grown to be a significant tailwind for technology companies. But how much of an impact does the AI growth have on the biggest businesses in the world? Nvidia had a $700 billion market valuation precisely 2 years ago. It is currently valued at about $2.7 trillion, making it the second most valuable company in the world after Apple and Microsoft. Amazon, a giant in cloud computing and e-commerce, increased its market value by just under $1 trillion in just 2 years. Even while Amazon's valuation is currently lower than that of Nvidia, I believe that during the next 10 years, the company may surpass the semiconductor behemoth in value. Let's examine how the AI revolution is changing Amazon's business. More significantly, I'll explain why I believe that investors should purchase and hold on to the stock for the long run at this time. Online stores, e-commerce, physical stores, advertising, third-party seller services, subscriptions, and Amazon Web Services, AWS, are the 6 main categories in which Amazon reports its revenue. Amazon's roots are in the retail sector, which is impacted by e-commerce, physical shops, and third-party seller services. The business has done a fantastic job of expanding outside retail over the years and pursuing higher-margin prospects including cloud computing, AWS, advertising, and Prime subscriptions. Even though AI has the ability to upend every aspect of Amazon's business, I'm most optimistic about AWS and retail. Amazon is making significant investments in AI robotics on the retail side. In essence, the corporation is equipping its fulfillment centers with robotic procedures that can help packaging and shipping services become even more automated and efficient. Over time, Amazon should be able to lower labor expenses in its warehouses, which will increase the profitability of its main retail business. Thanks to its $8 billion investment in AI startup Anthropic, AWS has experienced something of a renaissance in recent years. In September 2023, Amazon and Anthropic became partners for the first time. By the conclusion of the third quarter of 2023, AWS had an operating income margin of about 30% and an annual revenue run rate of $92 billion. By the end of the first quarter of 2025, AWS's operating income margin was close to 39%, and its revenue run rate was above $117 billion. It is profitable to have both increasing revenue and expanding profit margins. Additionally, Amazon is taking significant steps to strengthen the AWS platform, most notably by investing heavily in data center infrastructure and creating bespoke chipsets. The development of Amazon's own AI chips is still in its early stages. Similar goals are being pursued by its Magnificent Seven peers, Microsoft, Meta Platforms, and Alphabet. This probably won't assist Nvidia in the long run, but I don't think it will be disastrous. As of right now, Nvidia collaborates closely with each of these mega-cap tech firms. However, if more expensive AI processor solutions become available, these companies should not be as dependent on Nvidia. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
Lisa, you can't get away from the questions about tariffs, I'm afraid. I know on the call there were quite a few, and I'm going to go there as well because it is a key part here. I mean, do you have any expectations as to whether there will be sectoral tariffs or what they might be? And I also would be interested to know whether you expect there was some pull forward in terms of demand as a result of fear of potential tariffs.
Sure, David. So, look, I think we're all watching the regulatory environment, very, very carefully. As it relates to sectoral tariffs, we're in active conversations with the administration as they're thinking about both the short-term as well as the long-term policy. The long-term policy arc is we want more U.S. manufacturing. We want more manufacturing here in the United States, and we are actively moving a bunch of our manufacturing here, but we realize it's going to take some time, and I think that's the balance that has to come in play with sectoral tariffs, and we'll have to see how that comes forward. Now, to your question about the strength in our business relative to tariff pull forwards, I believe that, again, every customer and every industry is looking at this slightly differently. From our standpoint, our strength is actually very much focused on the strength of our product portfolio. I think the relative tariff impact was small, whereas the relative opportunity for us has been just end user demand for our products. But we're going to continue to watch this very carefully. And the beauty of the business, David, is I think we've learned to become very agile through all of the things that have happened in the semiconductor supply chain, and we're going to continue to watch all of these trends very carefully and make sure that we react appropriately going forward.
Yeah, you mentioned being agile as well on the call and said you have a good overall inventory position. I guess my follow-up would be, what does it mean to be very agile? What does that actually mean?
It means we have a great balance sheet. It means that we have great customer relationships. I think we plan for success, so we make sure that we are planning for a market that is robust to our products, but we will certainly adjust as needed if we see the macro weakening. Now, I have to say, for customer ordering patterns today, we're already, let's call it a month into the second quarter. The month of April was actually quite robust. So it gives us confidence that, people aren't making very short-term decisions right now. I think they're all wanting to ensure that we watch the environment but recognize that we've been through many of these types of situations before, and we're able to adjust the supply chains and our inventory levels as needed as we see how the macro does over the next couple of quarters.
Investors may want to brace themselves for less rapid growth in Nvidia's sales and profitability in the future, since its chip-making rival, Advanced Micro Devices, has already been successful in luring key buyers of its own competing GPUs, including Oracle, Meta, and Microsoft. It's very conceivable that Nvidia's valuation multiples would shrink if the release of more processors that compete with its GPUs turns out to be a disadvantage for the firm, and if its sales and profit gains lose their appeal to growth investors. Conversely, Amazon seems to be only beginning to capitalize on fresh chances for faster expansion, especially in AWS and its retail markets. However, it appears from Amazon's valuation trends that investors are not currently paying much attention to the company's long-term prospects or efficiency gains. Amazon appears extremely inexpensive when you take into consideration how much its operating profits have increased over the past few years in comparison to its market capitalization gains. However, if it continues on its current course, the business should be able to continue increasing revenues and generating billions of dollars in cash flow. This gives me hope that, in comparison to competitors like Nvidia, Amazon's valuation may start to rise noticeably over the coming years, eventually growing to a considerably greater size by 2030. According to analysis, Trump's tariffs had an effect on both Chinese and U.S. tech stocks. For instance, Trump's escalation of tariffs on Chinese imports to 145% by April 2025 led to a sharp initial drop in tech indexes in both countries. The CSI Overseas China Internet Index fell 18.94%, while the S&P 500 Information Technology Index fell 9.76%. The U.S. Tech Index rose 10.84% between April 3rd and May 2nd, 2025. The Chinese Tech Index fell 2.55% during that time. Therefore, it can be said that Chinese tech stocks are suffering more from the tariffs than U.S. tech stocks. This viewpoint is crucial as was previously mentioned, U.S. and Chinese tech stocks make up the majority of Tepper's equity holdings. About 16% of the portfolio is held by one Chinese IT company. This fact is worrisome to an investor who lacks the billionaire hedge fund manager's expertise and acumen. However, this specific situation is what makes Tepper unique. He takes chances, which, based on Appaloosa's return profile, frequently pay off. A tech business called Nvidia produces GPUs and SoCs, which are necessary for computing and artificial intelligence. It spearheaded the AI revolution, having begun with PC graphics. Nvidia, along with AMD and Qualcomm, is a significant semiconductor company, according to investor David Tepper. Strong interest has been expressed by institutional investors. Appaloosa Management owns a $91.32 million investment, or 1.4% of its portfolio. With 93% of the global GPU market, Nvidia is the industry leader in AI hardware. Its quick and effective Blackwell processor is used by Google, Meta, and Tesla, among other companies. Beyond chips, it's branching out into AI-powered medicine development and driverless cars, which will support its future expansion as demand for AI rises. However, Nvidia's present dominance might not last. The rest of world research claims that Chinese chip manufacturers are quickly catching up in terms of technology. Even while the businesses continue to fend off the consequences of trade restrictions, this is taking place. Significant progress has been achieved by companies such as Silicon's chip design arm. According to Huawei, its 910B AI chip is roughly comparable to Nvidia's A100 in some testing. Seaport Global Securities gave Nvidia a rare sell rating on April 30, 2025, citing a number of issues that can affect the company's future trajectory. Analyst Jay Goldberg set the lowest price target on Wall Street at $100. These include key clients creating their own processors to lessen reliance on Nvidia, and the possibility that AI funding could stall in 2026. On our list of billionaire David Tepper's stock recommendations with significant upside potential, Nvidia comes in at number 4 overall. Although we see Nvidia's potential as an investment, we are convinced other AI stocks have a better chance of producing larger returns in a shorter amount of time. While prominent AI stocks lost over 25%, one AI stock has increased since the start of 2025. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
We mentioned this number that you put on the restriction effect. How do you get to the number, and how do you think that, what's the trajectory of that figure as we go forward?
Well, Carl, let me start with first, we reported a great first quarter. I think we saw strength in across all of our businesses. We saw strength in our client and gaming segments. We saw strength overall in our data center segment. And I think that just goes to, the foundation of our business, which is, really on high performance computing. Now, to your question, as it relates to some of the China export controls that came out earlier in April, I would say that it is a headwind in our business. We said it was a $700 million reduction in revenue for the second quarter and $1.5 billion for the full year. But even within that backdrop, what we see is an environment which is very, very favorable to our product cycles and all of the great technology that we have coming out in 2025. So we still see the opportunity to grow strong double digits in 2025. And that is really on the strength of the overall portfolio that we have.
Yeah, a lot of the bullish notes today take note of new chips, right, that will be debuting relatively soon, going to impact favorably the second half. And then this notion, Lisa, I'm not sure how comfortable you are addressing it, of Intel as a shared donor.
Well, let me take both aspects of it. First, let's start with what we're doing. We are really about having very strong product roadmaps out there. We've always said that for all of the years that we've been talking. It's about having a great product portfolio that really plays to what customers need right now. So we see excitement in our data center portfolio. Today, our EPYC processors, our server CPUs are, all over, every major cloud provider is using our server CPUs. We have tremendous opportunities and growth in the enterprise market, where you see many of the Forbes 2000 companies also selecting AMD. And I think that's because, we've shown them year over year that we continue to give them significant total cost of ownership to make it more efficient for them to get their job done. We're also very excited about the AI opportunity. I think, AI, I heard you guys talking about it as I was coming on. I absolutely believe we're still in the very early innings of AI when we think about the opportunity. And yes, there are some, puts and takes and bumps in the road, but overall, we're still at the place where, enterprises are just beginning to feel what AI can do for them. And then also the PC market is a market that has done extremely well for us, and is a place where, again, people are upgrading their PCs. They want to upgrade to the best technology that has, great performance as well as great efficiency. And, that's what we have in our roadmap.
The stock of Nvidia is currently about 23% lower than its most recent peak. Many fear that if the economy weakens, so too will the need for its powerful graphics processing units, GPUs. Some claim that the trade in artificial intelligence, AI, has ended. However, the data points to a different conclusion. During their recent earnings calls, hyperscalers like Amazon, Microsoft, Alphabet, and Meta platforms, which together employ hundreds of thousands of Nvidia chips in their enormous data centers, all stated that they are rapidly increasing their capital expenditures in the area of artificial intelligence. Colossus, a supercomputer being built by Elon Musk's xAI, started with 100,000 Nvidia chips and is reportedly going to grow to 1 million or more. These wealthy corporations will continue to purchase Nvidia's products as long as Nvidia can continue to produce them, according to the evidence. Once again, Nvidia's most recent earnings report for the fourth quarter of fiscal 2025 was exceptional. Sales increased 78% year over year to a record $39 billion. Leading the way was data center revenue, which increased 93% annually to $36 billion. Despite spending $8 billion on stock buybacks, the corporation had $35 billion in net cash at the conclusion of the quarter, indicating solid financial health. As can be seen above, the stock is now considerably more inexpensive due to the recent price decline. This is almost the lowest projected price-to-earnings ratio since 2023. On May 19th, Nvidia will unveil the RTX 5060 graphics card, which will retail for $299. On the same day, laptops with the processor will go on sale for $1,099, though actual retail costs might be higher than that. According to Nvidia, retail partners will be able to purchase the RTX 5060 starting at 9 a.m. PT 12 p.m. ET. With 3,840 CUDA cores, the GPU has about 800 fewer than the RTX 5060 Ti, which debuted in April and has 8 GB of VRAM. The card has GDDR7 memory, improved ray tracing and tensor cores, and supports DLSS 4 with multi-frame generation. Prior to the debut, DLSS 4 will be supported by upcoming titles like MechWarrior 5 Clans May 7th and New World Eternum May 13th. The real cost can be more, even though the stated price is $299. Even prior to the latest legislative changes, GPU prices were marked up by U.S. vendors. According to The Verge, President Trump's removal of the de minimis import exemption may result in further duties on shipments under $800, which would drive up costs even more. Customers and analysts will be watching the market's reaction, particularly in light of the 8GB VRAM limit and growing cost pressures. AI will affect every job, according to Nvidia CEO Jensen Huang, who also emphasized that the true risk is that someone employing AI, not AI itself, will replace you. Speaking at the Milken Institute conference, Huang stressed the importance of early adoption and encouraged professionals to begin utilizing ChatGPT and Perplexity. Due to concerns about overbuilding chip capacity domestically and U.S. export limits on AI chips to China, Nvidia's stock has dropped 15% so far in 2025. Although it will probably be slower than the record-breaking rise in 2024, Huang still anticipates great results this year. In the meantime, Microsoft, Alphabet, and Meta Platforms announced that they are increasing their spending on AI while also reporting strong Q1 profitability. Tech valuations are still appealing, according to investor Robert Smith of Vista Equity Partners, who cautioned Yahoo Finance that not all businesses will adopt AI, particularly those that haven't perfected their data and workflows. Investor mood at Milken indicated that AI infrastructure was a long-term growth topic, notwithstanding geopolitical uncertainties and short-term volatility. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Hey there, Kevin. So S&P has decided to take a turn lower, down about 0.2% right now. So some gyration, although no huge moves here. So talk to us about the levels that you're watching on the S&P 500 heading into the close.
Yeah, going into the close here, we want to be able to hold this 5,600 level. I think that's going to be very key, Caroline. We've been actually in a pretty consolidated range here today, just overall, after we had that, after we defined it here. Now, the Fed meeting so far, when you're looking at the commentary, did it provide a lot of fireworks? I would say it did not, actually. I think it was right in line with the street's expectations, but the market's probably also reassessing President Trump's comments around keeping the 145% tariffs in place before these meetings over the weekend. So I think that's something to contend with here. When you're looking at the flows, there's going to be some pen risk sitting at 5,600. So let's be mindful of that. And going to the upside here, 5,630 is actually going to be the first area that I'm looking at, even though 5,640 actually has the confluence or that major structure of short calls sitting there here. But once again, we just had the news flow that just didn't really cooperate with some of the bullish positioning that we saw in the market. And actually, you can see that with the volatility markets as well. VVIX or Vol, the volatility index of the VIX, if you will, has still actually stayed pretty elevated even post this meeting. And what's a little bit concerning right now is that we have not seen a backfilling of liquidity back into the E-mini S&P book depth. And that's just something I always keep an eye on. We've actually seen liquidity increase and book depth actually get healthier over the last couple of trading sessions. And it's not out of the ordinary that we see that contract as we have a major event like today. But after the event, usually that liquidity comes back into the market. And that's just not the case. What I got also a little bit concerned about is the advanced decline line, if you're looking at it for the NYSE advanced minus the declining stocks here, is actually making new lows. And if you look at some of the mega cap names that we try to rely on here, obviously Google's having its own type of day, but Nvidia, Google, Microsoft for that matter, all look like they're trying to hinge lower, and that's really not great. You want to be able to see those stocks really hold up here in order to try to get us an opportunity to try to close at least at this 5,600 or try to hold the 50-day moving average for the S&P 500. That's also going to be a key area to focus on here.
Yeah, Amazon and Meta, the only Mag 7 names firmly in positive territory right now. Netflix higher today as well. All right, how about on a daily chart? What levels are you looking at a little bit further out?
Yeah, so the daily chart, I don't have any changes when it comes to the level. 5,700 to the upside here, 5,400 to the downside. But I really want to kind of focus on two things. The candle structure. We have almost, let's see how we close out today, pretty much three doji candles in a row. You could say maybe yesterday was a little bit more of a shooting star candle, but what does that really mean? It shows that there's indecision in the market, maybe a little bit of an exhaustion period taking place here, even though we're holding up key areas of support, that 5,600, the 50-day moving average, which is sitting at around 5560.8. But because of this stalling out, especially for today, which kind of took me by surprise, I thought we might actually see some action here in the market and actually see a directional trend taking place. Because of the stalling out, you actually have some of these momentum indicators actually flashing maybe sell signals in the market here. The first one that I have at the top there is going to be that stochastics, and that fast moving line, that red line here, has crossed the overbought level here. And if you kind of go back and look, you just over the past 3 months, which is what we have this chart, these crosses where the fast moving average crosses below that purple moving average, which is the slow moving average, and that cross below that overbought territory also then usually coincides with sell-offs. We had that back in February. We also had that same type of cross taking place back around middle of March, end of March, if you will. And now we have another one. Also looking at the CCI, which measures the 14-day moving average and the price action compared to that average, or the deviation, if you will. That also has given a sell signal on the daily chart. So the weekly is still holding up. Daily chart says, hey, sell signal, but that doesn't mean that we have to make new lows. It just means that maybe a pullback is taking place because of the stalling and price action. And unfortunately, going back to the fact that the news flow really wasn't conducive for any type of major push to the upside, kind of signifies that maybe these technicals are starting to hold up. And unfortunately, that dispersion trade that we talked about yesterday doesn't seem like it's going to come to fruition as well as volatility continues to be elevated.
Okay. Yeah, I was actually just thinking about that dispersion trade from yesterday. All right, so I know you also have a dollar 10-year chart to tell us about, so fill us in on that.
Yeah, so the dollar 10-year kind of correlation here is actually very interesting when you kind of think about it. Now, one thing to just kind of note, you are seeing obviously a little bit more of a correlation here, but you want to keep your eye out on where the dollar is really going. We saw a lot of strength moving to the upside for the dollar here today because of this announcement that's taking place, and rightfully so. You saw a consolidation for the dollar index over the last couple of trading sessions here, and it seems like we're trying to retrace higher, but that will have a little bit of an impact when it comes to not only treasuries, but also commodities. Gold is making a move to the downside, even though we have a pause that's going to be taking place, maybe some uncertainty for a June rate cut here, as well as the tariff uncertainty. So something just kind of keep your eye out on. We are seeing a little bit of a divergence for now. But overall, once again, we want to be able to hold the 5,600 level for the S&P 500. I think that's going to be critical for us to try to continue this rally that we've seen over the last couple of weeks.